Hello and welcome to today's Smart Business Strategies podcast. I'm Ann Wiles, the franchise economist. Today we're going to talk about how not to be sucked into an ad that says franchise for under $30,000. Okay, that is one of the most misleading ads you'll ever see. Sounds like a dream, right? Well, let's slow down. What the $30,000 or less is referring to is most likely just the franchise fee. It has nothing to do with the full cost of launching and operating a business. That's what I call the total investment. So let's talk about, not only does it not cover startup cost, operating cost, it does vehicles, equipment, furniture, all that sort of stuff. So we'll break this down. I want to share questions with you so that you can ask current owners what the real story is and not fall just for the sales pitch. Okay. And I'm going to go ahead and tell you one of the single most important things you need to ask about from both the franchisor and franchisees is working capital reserve. How much do you need? All right. So when people see an ad claiming $30,000 or a franchise for under $30,000, why should they pause before getting too excited? Well, as I said, there's a lot more to it than just paying the franchise fee to launch and operate a business. It's like when you buy a house, you don't just look at the down payment, right? You need to budget for mortgage payment, taxes, insurance, maintenance, those sorts of things. All right, the reality of the franchise fee. What does it cover and what doesn't it cover? Well, let's talk about that in some detail. The franchise, if you are awarded a franchise and pay the franchise fee, then you're given a license. You have the right to operate under the brand. You will be given access to the brand standards for that particular franchise. You'll have initial training. You'll have access to systems, operational support, and use of trademarks. It includes startup guidance, but rarely, if ever, are any hard costs like vehicle, equipment, furniture, rent, things like that are not included at all. That's in addition. When I explain to people, why go with a franchise versus an independent business, pretty much the total investment should be the same with the exception of the franchise fee. The franchise fee is like paying tuition. You know what to do from day one and what not to do from day one. They teach you, they train you, and they support you. They give you the playbook on how to run and operate the business. With a business of your own, an independent business, you still have to have a startup location. I mean, if it's location based, build out, hire staff, have money for that, have money for marketing, buy systems, buy the technology and signage and insurance and all that sort of stuff that you need. All right. So what you want to do is validate the value with current existing franchisees. Do they ask them, do they feel like they're getting value for what they paid for the franchise fee? I personally don't care if the franchise fee is $10,000 up to $50,000 or more. I mean, whatever it is, are you getting value for that? To me, the lower the franchise fee, the less value you're going to get. So should you really go with something just because the franchise fee is $10,000, whereas this one is maybe $35,000? Not necessarily. You really just need to see what are you getting in return for that. All right, and you get that information from talking to franchisees. Okay, let's look beyond the franchise fee. What are the typical additional costs that you should expect for both a service-based business and a brick and mortar based business? All right, so even if a business is home-based, you still may have a total investment of up to $150,000. And you're like, wow, how could that be? Well, you may need to buy or lease a vehicle. You may need to buy software. computer system, insurance, and of course, there are going to be marketing costs. And then we haven't even talked about if you have any employees or if you use 1099 contractors. For a home-based service business, the lowest I would suggest for a total investment figure would be about $75,000, and 75 to 150,000 and up is what is kind of typical, pretty common. All right, so what about a brick and mortar location? Well, of course, that involves build out, renovation, furniture, signage, inventory, and staff. And these easily run 250,000 to 500,000 or more per location. Now, there will be exceptions, like a tax preparation office shouldn't be $250,000 unless you have a massive office. But just in general, I'm going to just say probably the majority of the franchises that I work with that are brick, it's 250 to 500-ish per location. So if you want to scale and grow, then you multiply that by how many locations you're interested in. And each location or each territory, whether it's service-based or brick and mortar, will have its own independent franchise fee. So if the franchise fee is $30,000 for one, the second could be $30,000, and then the third, maybe they give you a discount and call it $25,000. So you'll pay a franchise fee per territory. All right? All right, so ads rarely explain the difference, which can lead to sticker shock once you get something called the franchise disclosure document, or the FDD, which is how we reference it in the franchise industry. Every franchise has a franchise disclosure document. It's about this thick. It has lots and lots of wonderful information in it. It's a gold mine of information, including investment ranges, franchise fees, royalty percentages, and that sort of thing. So let's break down the true or total investment. The key, the big variation, is in the working capital reserve. That is the money you need, the cash on hand you need to pay your people, pay your rent, pay your expenses until the business generates enough revenue to support its operating expenses. Okay, and how long will that take? Well, it will depend on a number of factors. It will depend on the skill of the business owner. It will depend on whether it's home-based or location-based, or a service that doesn't have the overhead expense and the startup cost of a location. All right, so some other things, maybe some less obvious expenses you also want to take into account are these. And a lot of times, first-time franchise business owners overlook them. The one is cost of travel and lodging to go to training. In-person training, usually at the corporate headquarters of the franchisor. And this can be a week. You may take a spouse, you may take a key employee. So that's something else to take into account. And of course, professional fees. I refer everybody I work with to a franchise attorney and also to a franchise CPA before they sign on the dotted line. And also there are franchise funding companies that I refer people to so that you can figure out what you can comfortably afford and what funding strategy is best for you. Is it a particular SBA loan? Is it using a HELOC, equity in your home? Is it rolling over retirement fund monies without tax or penalty from a former employer? So all these things need to be figured out. Of course, your funding strategy, your investment level, and take into account not only training costs, professional fees, technology, it's called POS, point of sale systems, CRMs, customer relationship management systems, phones, scheduling software, laptops, and of course, website development. A franchisor will often include that in the franchise fee. Also, payroll float. I mean, you need to have money in the bank to pay your staff. And of course, there's marketing spend. There's usually a grand opening expense or budget just for grand opening. their online ads, their local promotions, and that kind of stuff. None of that is mentioned or referenced when they go, hey, franchise for under $30,000. Now, one area some people get really confused about is what is the break-even point? As I alluded to earlier, break-even means the business generates enough revenue or income to cover the operating expenses, like paying the rent, paying the employees, paying your insurance. When enough revenue comes in to cover those expenses, you have broken even. Up until that point, you're operating at a loss. And that's why you need cash in the bank, which is called working capital reserve, to pay all your expenses until the business can support itself. Big question is, how long does it take to break even? Well, that will depend on a variety of factors, everything from the franchisee and their abilities to just the nature of the business. A home-based business will more than likely ramp up much quicker than a brick and mortar location. That's just the nature of the beast. Brick and mortar locations have higher cost, so you have to generate more revenue to cover the higher cost to break even. There you go. All right, so one thing that I really want to emphasize again and again is the importance of this working capital reserve. Working capital reserve, which is just cash in the bank or accessed cash to pay your ongoing bills. I've never heard anybody say they're sorry they had so much working capital reserve. I've heard the opposite. They are sorry they didn't have enough working capital reserve. So it's just necessary to have that in the bank. And haven't we all seen independent businesses open to great fanfare and then less than a year later they're out of business? It's because they were undercapitalized. They didn't estimate the working capital reserve they needed. All right, and that is in massive contrast to franchisors that have an overwhelmingly very high 90% or higher success rate. Why is that? Because franchisors will not award a franchise to anyone unless they see the money that they have for working capital reserve, startup, operating expenses. You have to have the minimum financial requirements based on liquidity and overall net worth, credit worthiness, all that sort of thing. So franchisors will not award a territory to anybody unless they see they have the money first. And that is why they are so successful. One of the many reasons they're so successful as opposed to independent businesses. All right, so I want to set some realistic expectations for you before we sign off. If someone is budgeting for a franchise, what's a more realistic total investment range that they should be prepared for other than, $30,000 like the ad says? So to emphasize, for a service-based business that's home-based, at the very lowest, $75,000 to $150,000. That's a pretty good range there. I actually like $100,000 just so you're not cutting it too close. Brick and mortar, in general, there'll be some exceptions, but I'd like you to have, in franchisors in general, like you to have at least $250,000 to put towards a total investment. Now that can be a combination of cash on hand, liquid assets like stocks, rolling over retirement fund monies, getting an SBA loan, etc. All right. So every franchise disclosure document has 23 sections. They're called items. Item 1, Item 7, Item 19. Item 7 is the estimated initial cost. And there will be a very wide range there because it covers every market in the U.S. where there's a franchisee. It will have the lowest number someone had for getting into the business and the highest number. So this covers Manhattan and Podunk, Iowa. Okay, so it's going to be somewhere in between probably for where you live. The best thing to do is to ask current franchisees what their startup costs were, what their working capital reserve needed to be, and how long did it take them to break even. Now, you're not going to mimic anyone else, but gather this information from a variety of franchisees, and you can get a pretty good feel for what would be appropriate for you in your market. So speak with a number of franchisees in different markets to confirm whether their numbers, match the reality of what's in the item 7 of the FDD. Okay, so next time you see a flashy ad claiming you can own a franchise for just $30,000 or less, it's usually only the franchise fee. The real cost includes training, build-out equipment, vehicles, payroll, marketing, and months or many months of working capital reserve before you break even. The smartest move, validate the value of the franchise fee by talking to current franchisees and review the numbers that are in the FDD. Ask franchisees about their expenses, working capital reserve, time frames, training, support, business model, marketing strategy, all these things. Are they happy with what the franchisor offers, and would they do it all over again? You want to know the answer to that question. So if you're serious about exploring franchises and want the facts, not just the fluff, I want you to reach out to me. I'll help you cut through the noise, analyze the best opportunities that are a fit for you, your wallet, and your goals. And thanks for tuning in to the Smart Business Strategies podcast. I'm Anna Wilds, the franchise economist. Be sure to like and subscribe to our channel so you don't miss the next episode. Come back next Wednesday at noon Eastern for 15 minutes, and may you be wildly wealthy in all areas of your life. See you next week. Bye-bye.